Hi, this is Sonnie Bailey from Fairhaven Wealth and the New Zealand Wealth and Risk blog. Every now and then, I'm asked to give a presentation to a group of people about money and related topics. And one of the things I've found is a great way to rehearse for that is to just record myself while giving the presentation. So here's a presentation that I'm going to give later today, and this is basically my rehearsal, and I thought I'd record it and make it available more broadly. You are here. So we're all here physically, wherever we are. Some of us perhaps more in body than in spirit, but we're all here. And not just here physically. We're all here within the broader context of our lives and the story of our lives. We all have our own unique experiences. We all have our own fantasies, fears, dreams, desires, values, and beliefs. And it's really important to keep that in mind in relation to any financial decision that you make and in relation to any lifestyle decision that you make. So I think that's really central, both to keep in mind in respect to this presentation and in relation to any advice or anything you come across in terms of making important big decisions in your life. It all has to come down to you. On a related topic, I want to talk about what wealth means to you. And that's really important. As a financial advisor, it's very easy for me to think about wealth in financial terms. And I think a lot of people think about wealth in those terms as well. But you could end up being the most wealthy person in the world, but if you have terrible health, terrible relationships, and you're miserable, by my own definition of wealth, that isn't really living a successful or wealthy life. And so my definition of wealth is probably going to be unique or idiosyncratic to me, and the same way it's likely to be unique to you as well. And I find that really interesting. As an advisor, I have to work with clients and they're all different. So I might have two sets of clients who have objectively very similar circumstances. They might have similar ages, similar asset positions, similar incomes, and the advice I give them might be very simple, but might be profoundly different based on where they are, who they are, and what they actually want to achieve. So again, keep that in mind in relation to any financial decisions that you make. Now, in the context of this conversation, I'm going to talk about a little bit about investing, and I'll touch on insurance very briefly as well. Before I get into that, I think it's just worth noting that before you invest, you need to have funds to invest, and saving is really important. Now, I'm not too sure how many people are familiar with Mr. Money Mustache. He's kind of one of the pioneers of what's called the FIRE community, or the Financial Independence Retire Early community. And this particular article, I mean, his website's a pretty terrific resource, but this particular article, the shockingly simple math behind early retirement, is a classic. It really makes it very clear the importance of savings, or your savings rate, and how important that is to getting into a good long-term financial position. And so the way I'd characterize it is that, I mean, the more you save, the quicker you save, obviously. But the higher your savings rate, it also means that the lower the cost of your living is, so that in order to, say, retire or retire early, the less you actually need to accumulate. So it's a double whammy. You're saving faster and you're saving more and you need less. And that's something to really keep in mind. And that's not to say that everyone should have a super high savings rate. Again, it comes down to your own values and priorities. But the key important thing is that savings rate is important. Unless you actually have funds to invest, you can't invest in the first place. And there's really two components to that. I've kind of touched on the importance of spending less than you earn. And the second component, I mean, it might seem those two statements on the slide are a tautology, but there's also the earning side of things. And the better you can position yourself to generate a decent income by adding value to your employer or whomever you work for, the easier it is to save. I mean, there are a lot of financial gurus that will say that it doesn't matter what you earn, but it does. It makes an enormous difference. Beyond a certain standard of living, it's very hard to spend more. And frankly, most people who are wealthy don't lose their money from spending too much. It's usually either through things like substance abuse or, in most cases, poor decisions. So I'm going to talk a bit about investing or growing wealth, and this chart here provides a simplistic overview of what it's like to invest. You can have some ups and downs and a general trend upwards, but I actually prefer this chart. And in some ways it communicates the same sort of message. You invest over the course of a long period of time and you're likely to end up in a better position over that period of time. But just to briefly explain what this chart refers to is there's about 100 odd different lines here, and they all relate to the same thing, which is investing $1 million over the course of 30 years. Now, what's really interesting about this chart is its historical returns, and it's for effectively the same investment portfolio. The only difference between each of these lines is the year the portfolio began. So one of those years will be 1905, one will be 1929, one will be 1939, 1945, 1987. And what you'll see here is that depending simply on that one variable, when that portfolio began, that has an enormous impact on the long-term outcomes. Can I tell you which one of these will be what you experience? No. Can anyone? Frankly, I don't think so. And I think that anyone who tries to give you any certainty like that will probably revealing more about themselves than what the future actually holds. But what you can see is the general trend, and what we can get is general rules of thumb in relation to investing. So for example, this is a portfolio of kind of growth-oriented assets, or a share portfolio. If it was say a bond portfolio, you'd still see the same upward trajectory, but the vertical axis will be much lower. So you might see growth, but you're probably not going to see the same level of growth if you invest in more defensively oriented investments. You would probably see less volatility though, which is more variation, less variation when you invest more defensively. When investing, going back to the same theme, you should always make decisions based on your circumstances, your needs, your objectives, your values and priorities. And so the way I explain it to a lot of my clients is that if you have a good investment plan or an investment strategy now, it should still be appropriate for you in 6 or 12 months' time, regardless of what's in the news or what the news of the day is or what you think the future might hold outside of your control. The key should always be your circumstances. For example, your cash flow needs and how long you plan to retire and your ability to sleep at night. Now, sure, your circumstances, your needs and objectives can and they will change over time, and your plan should change to reflect that. But that should always be central to any investment decision that you make. It's also worth noting that there are lots of ways to invest. So I'm a financial advisor. Most people come to me wanting advice in relation to financial assets, shares, listed property trusts, bonds, term deposits, and that sort of thing. But it's also valuable to keep in mind that they're not the only ways of investing. I mean, an obvious alternative is real estate or property, whether that's direct property or in some sort of listed way, or some property trust. You can also invest in businesses or ventures that you're involved in or that you want to assist in. You can lend money out, and peer-to-peer lending is a good example. But you can also do things like you can invest in yourself. For young people in particular, I mean, education is probably one of the best possible investments of their time and of time and resources that you can possibly make. That's often the case for people at many points in their career as well. So when it comes to investing in financial assets or just investing generally, the most important decision is getting your asset allocation right. Now that sounds like a technical term, but what that really means is your split of how you invest in, at the highest level, growth assets and defensive assets. And by growth assets, I mean shares, property, the sorts of investments that tend to have higher risk and return characteristics. So there might be more ups and downs over the short term, but they tend to generate better returns over the long run. And defensive assets, on the other hand, include cash under the mattress, cash in the bank, term deposits, and bonds, and investments of that sort of nature that tend to generate less in returns over time, but have a lot less volatility over the short run. So here's just a more detailed illustration. So you might have growth assets of 56%, and that might be constituted of shares overseas, Australia and New Zealand, and your defensive assets might be constituted of cash, fixed interest, and the like. Now, it's important to keep in mind that this asset allocation should refer to your investment portfolio, or all of your investments as a whole. So you might have investments in KiwiSaver and property, you might have cash in the bank, you might have some shares, you might have a managed fund or two, and what you need to do is work out what your allocation within each of these investments are and how they feed into your broader asset allocation. And so you can't really look at any one individual investment on its own. It all needs to be seen in the broader context of your situation. And so thinking of KiwiSaver, for instance, on its own, I mean, it's valuable. I mean, for most people, you would probably invest according to how long until you were going to access it and whether you needed to use it for a home or anything of that nature. But really, you should be looking at it in relation to all of your other investments. Don't put all of your eggs in one basket. In other words, diversify. So the way I would describe this, if you're managed to invest in one share, you are subject to whatever happens in relation to that one particular company, all of the ups and all of the downs. If you can invest in a number of companies in a number of different countries, in a number of different sectors, you're not going to suffer the massive ups and downs that will go along with investing in one individual company. Even within the same sector, you might have Apple, for example, and Samsung, and Apple might release the best product that they've ever released, and that might be great for them, less for Samsung, but it evens out over the course of them. And the same, you might have the technology industry, might have a good year, and the resource industry not, but it all balances out in the same way with different countries. So all else being equal, don't put all of your eggs in one basket. Fees never sleep. That's a phrase from Warren Buffett. Be wary of paying unnecessary fees, especially when it comes to investments. The world of investing is interesting. There are a lot of domains in life where spending more will get you better goods and services. That's not necessarily the case when it comes to investing. In fact, there's a fair amount of research that goes to show that the fees you pay in relation to investments and the returns you get are actually negatively related. And so you can't predict what returns you're going to get, but what you can predict and what you can control are the fees. So all else being equal, try to pay as few fees as possible. And it's remarkable. I mean, a difference in 0.5% or 1% might not sound like a lot, but think of it this way. You can 1% of your entire investment portfolio might not seem like a lot. But if you think about it in the context of your investment returns, it's a lot. So for example, let's say your investment portfolio generates a return of 5% over the course of a year. If you're paying in 1% an extra in fees, that's 20% of the investment return that you're actually getting. And in that context, it's a lot of money, and you can end up paying thousands or tens of thousands of dollars more in fees than you actually need to without really being aware of it. Keep it simple. Another thing that's interesting about the world of finance and investing is in other areas of life, good things tend to come to those who hustle and work hard and do everything they possibly can. Whereas when it comes to investing, that can often be counterproductive. And the way I would kind of explain it to a lot of people is the best thing you can possibly do with investing is to make your financial affairs and investing as boring as possible, make the rest of your life interesting. And frankly, I think you can go a long way with investing in low-fee, index-based, widely diversified funds with independent trustees, both within KiwiSaver and outside of KiwiSaver. To be honest, I mean, this is not advice for you guys, but the majority of my advice to my clients is to invest in one or more of the funds issued by Simplicity or Superlife that meet those characteristics, which are extremely widely diversified. They're liquid, which means you can turn them into cash very easily, and the fees are very, very low compared to other funds of their type. Now, when it comes to investing, there's a few different philosophies. There's, you can probably think of it as a spectrum. So there are some people who think that they can pick stocks either themselves, or they can pick individuals who can pick stocks, like investment managers. There are other people who kind of think that that's a little bit futile, and so they'll just go and invest in the index or kind of passive investing. I'm pretty firmly down this side. I understand there's room for good faith debate. The way I'd kind of characterize it is that when you're investing, you are making a prediction about the future for that particular company or set of companies that you're investing in. So when you invest in a share, I mean, sure, you're buying an interest in a company, and sure, you will look at the asset position of that company and its current level of profitability. But what you're really doing is you're making a bet on the future. The value of that investment that you make is entirely predicated on the future of that company. And that can be subject to numerous factors, many of which are even outside of the company's control, and are very hard, if not impossible, to predict. So that's what investment managers are effectively trying to do. They're trying to make predictions about what the future holds for any given investment. And the other thing I'd say is if you're thinking of making investment decisions on your own, keep in mind the fact that there are a lot of professional investment managers out there. You're not just playing a tennis match against your neighbour or somebody local person at your club. You are on the same playing field as a lot of professionals. Now, these investment managers are all smart, they're all well educated, they're all well resourced, they're all heavily incentivized, and they work hard to try to get the best possible returns and make the best investments for their clients. The challenge for them, even for these people, is that at the other end of most of their transactions are other smart, intelligent, well-resourced and incentivized people trying to make decisions similar to them. And even worse than that, these transactions aren't just one-on-one. The value of any given share or investment reflects a consensus view of hundreds, if not thousands, of these investment managers all trying to determine what the future for any given company represents. So the way I kind of characterize it is that I would prefer to just rely on the wisdom of that crowd. I don't think any one particular individual is going to consistently be able to outperform all of the other individuals out there. There's a lot of them, and the more there are, the harder it is to outperform. And that's kind of my background and why I tend to prefer index-based funds. There's room for good faith debate. And the other thing I would just characterize as my philosophy is that you shouldn't necessarily try to beat the market. You should always try to make sure you're not beaten by the market. And usually the lower fees that you pay, because you're not having to pay enormous fees for these investment managers, will more than make up for any kind of average performance that you might generate over time. The other thing I'll just say in relation to prediction is that, I mean, this is one of the hard things about preparing a financial plan. There's a whole range of uncertainty in relation to the future, especially at the individual level. I mean, if you're trying to plan for retirement, how much do you need for retirement? It's a challenging one. I mean, it depends on what your expectations in terms of what you want to spend and the lifestyle you want to have over time. And even while you're working, it can be very hard because your lifestyle as a working person can be different from your lifestyle as a retired person. There can be some expenses that are higher and some that are lower. The other factors, which are impossible to know, are what your health will be and how long you'll live. We don't know what investment returns are going to be. Which one of those lines will you be on? Um, what what government policies will change? For example, New Zealand Super, in terms of entitlement to eligibility and what level of New Zealand Super you'll receive. Will you need residential care? There are all sorts of these factors. Or will you have loved ones that you will need to help out? Or will you have some one-off unexpected costs? Very difficult to know these ahead of time. And I mean, just frankly, I mean, it's hard to predict what the world will look like in 20 or 30 years' time if you're hoping to live a long, healthy, happy retirement. What social, technological, economic, environmental, political changes are going to occur, and what is the backdrop of the retirement that you're going to have going to look like. So the one thing I would probably try to stress is that you can never have certainty. And anyone who's trying to give you certainty, I think, is again revealing more about themselves and than what they know about the future. What you can have is some degree of comfort and confidence in making sure that you're planning appropriately for the future. I'll touch on insurance very briefly. Now, insurance is a tool for managing risk. So we're all exposed to risks, and it's an important part of my conversations with clients because the way I often explain it is it's one thing to focus on the things that you want to achieve. It's also important to think about the things that you don't want to happen. And insurance can be a really important tool for helping to manage especially those catastrophic financial risks. But it's not the only tool. So for example, I mean, if we think about life insurance, which is the type of insurance that pays a lump sum if you pay out, if you pass away before a certain age, that's not the only way of managing that particular risk. I mean, you can make lifestyle or health decisions which might reduce the likelihood that you will pass away before a certain age. You can also build or accumulate wealth over the course of your life, which might make life insurance unnecessary. I mean, Bill Gates doesn't need life insurance, for example, but he's just an extreme example. There are lots of Kiwis who don't need life insurance because they've got accumulated the wealth to make that unnecessary. So it's important to keep that in mind, that insurance is just one tool of many for managing risks, but it's an important one. Now, there's different types of insurance. You've got the general insurances, which usually cover stuff, car, contents, home. And then there's personal insurances, which usually cover you. So that might include health insurance, life insurance, which is what pays out if you pass away, trauma insurance, which pays out a lump sum, usually if you're diagnosed with a specific illness, usually cancer or heart issue or a stroke. Total and permanent disability, which again pays a lump sum if you become totally and permanently disabled, and that will usually help cover costs associated with adjusting to your new normal. You might provide a lump sum to provide some supplemental support during that period of time. There's also income protection insurance, and I'll touch on that very briefly because I think it's a valuable insurance to keep in mind, and I'll illustrate that with a chart. So one of the things I often do with clients is that I run them through what I refer to as floorcast scenarios, and I call them floorcasts because the only guarantee I can give is that they will be wrong. But it helps you see your financial trajectory, not just as it currently stands, but what your financial trajectory may look like over the long run, based on a certain sets of assumptions and things that you may be currently doing. Like, for example, your current rate of mortgage repayments and when you'll have the home repaid, what you're contributing to KiwiSaver and what you might be saving down the track. And so this chart on the left illustrates a 39-year-old or a couple of 39-year-olds, and it might show a forecast or trajectory of what they might look like, their financial life might look like if they continue accumulating assets until the age of 65, at which point they retire and then slowly and steadily accumulate some of their capital to support their lifestyle over what is hopefully a long, happy, healthy retirement. The chart on the right is identical in every way, except instead of retiring at the age of 65, they retire at the age of 60. And as you can see, instead of ending up with a substantial amount of money when they become centenarians, they basically run out of money before they turn 83. Now, that might be a legitimate decision. Maybe that's what their expectations are. Maybe they'd be happy to recalibrate what their expenditure requirements might be by retiring early. That's a decision for them to make based on their circumstances and what constitutes wealth for them. But it's important to keep in mind that when we think about retirement, it's very easy to think about retirement in voluntary terms, but often that's not always the case. Some people retire involuntarily, and there are two main ways that this happens. So one is sometimes retirement can sometimes be thought of, it can be used as a euphemism for being displaced from the workforce. People in the twilight years of their career might face a redundancy and be unable to find anything equivalent to their previous role or find a role at all. And that's unfortunate. And again, that's one of those risks that you can't insure against very well, but you might be able to manage by investing in yourself and your connections and your ability to add value to your employer and clients. The other one is that a lot of people retire involuntarily because of health issues. Now, if you're unable to work because of an accident, then you might be covered by ACC. But if it's not an accident, for example, a major health issue, then you might be forced to retire and you might not get much or any government support whatsoever. And so you're effectively forced into this situation where you retire early and you haven't had the benefit of those few years near the end of your retirement that can be really key to accumulating the nest egg to support the quality of your life and that you want in your retirement. And that's where income protection insurance can come in. So what you might be able to do is pay income protection premiums to help manage that risk. So what it might mean is you might pay monthly premiums, which might seem on the high side. It might mean that you end up accumulating less in the left-hand scenario than you otherwise would have, but you'll still end up accumulating enough to support the lifestyle you want over the long run. And in doing so, you are managing the risk or the possibility of experiencing the scenario in the right-hand chart. And so again, it's a way of managing what to many people might be a catastrophic risk. Now, I'll completely open that these two scenarios won't be an accurate reflection of what might happen. Unfortunately, if you're unable to work for a period of, say, 5 years or so, that might impact your longevity, in which case you might not need to have funds to support you until the age of 100. On the flip side, you might still live for a long time, and it might even be possible that your cost of living will be higher than it otherwise would be. We don't know. I mean, that's one of the fundamental things with insurance and with planning that I've already alluded to, is that we just don't know what the future is. And that links into this particular quote that I really like from US President Eisenhower, that plans are worthless, but planning is everything. Again, certainty is not something you can have, but having some level of comfort and confidence knowing that you're doing all of the right things is really important. Before I move on from insurance, I will just say that insurance is complicated. So the way I provided insurance advice to people is I talk about what types of insurance you might need, life, income protection, trauma, TPD, what level of insurance might be suitable, but I don't recommend specific providers. And the reason I don't do that is because it's really hard. Every insurer is different, and every insurer will have a different appetite for what risks it's prepared to take and what exclusions and underwriting decisions it might make, they might be prepared to make. Another one is, and there can be real differences in the details of the policy terms. Another one is that, so for that reason, I engage an insurance advisor for the purpose of getting personal insurance, and I recommend anyone to do the same. The other thing I would say is that having a good quality insurance advisor, they'll help you at claim time. And if you deal with an insurance directly with the insurer, you've got no one really there to step up to the plate and help you and exert whatever knowledge or experience or leverage they have to help make a claim. I mean, at the end of the day, that's why you get an insurance policy, to pay out when you need to, and having someone there in your corner is incredibly valuable. So I'll wrap up, and I'll just ask this question again. What does wealth mean to you? I love this quote from famous philosopher Jim Carrey, saying, I think everybody should get rich and famous and do everything they ever dreamed of so they can see it's not the answer. And he knows from experience, as for a period one of the most well-paid Hollywood actors, that he got everything materially and objectively that he ever wanted, but it still wasn't what made him happy. The other thing I'd just say is that think of other ways to invest. Invest in yourself, not maybe just in education, but I've got to say that being resourceful, which is why I've used MacGyver, is a really valuable skill in itself. It's not something that shows up on a balance sheet, but it's quite possibly the most important asset that you'll ever have. For one thing, most resourceful people do end up getting into a good financial position, but regardless, if you're able to make the most of whatever resources you are, you're always going to be fine. Invest in relationships and invest in your health. I often ask clients what don't they want to happen, and even though we're talking about their financial situation, their first things aren't ever that we might lose money or we might not have money or anything like that. It always relates to health for themselves and their loved ones and their relationships with the people that they care about. Your health is your wealth, and the people in your life are important. So I'll finish up this presentation just with this quote from Jonathan Swift, and it resonates deeply with me, and I hope it resonates with you. Wise person should have money in their head, but not in their heart. Thank you.